All right, so we're doing this video a little later in the weekend than normal as I spent yesterday, Friday, going to our state championship game for our little community and our high school team, football team. We couldn't pull it off. Lost 8-0. It was a defensive struggle. A few mistakes here and there kind of led them to get their 8 points. But it was fun to make that trip nonetheless. A 6-hour round trip. That's why I didn't do the Market Outlook live on Friday and the delay in the video. But fun times, seeing a lot of friends and family and kids that that try so hard. So that's why this video is delayed. It was quite the day yesterday in the markets, significant day from a technical standpoint. So I'm going to break down that significance, what it all means, and kind of give you some context for this short-term move that we've had and what that means and where we've seen this before and what to expect based on that. And we'll take a look at a bearish trade idea. I know we've been really heavily bullish, but we'll take a look at a bearish trade idea again today with our Market Outlook trade. So let's go ahead and get started. Today is Friday, November the 15th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, all three lines, really close to four, but all three lines finish in the upper reversal zone, which creates an overbought cluster. Now, that is not an immediate trade signal. The last overbought cluster we got, we've only had two this entire last 52 weeks, but it was right here on April the 26th. Now keep in mind about April the 26th that was a period where we had already been on an intermediate run with the green line crossing above 50 for over 3 months by the time we got that. So we had a mature intermediate run when we got that overbought signal. We do not have a mature intermediate run now. We're only a month into this. This would be considered a short intermediate run according to its normal range of 1 to 3 months. So not considered a reversal signal. Almost a little bit considered a validation that this is a good, strong, bullish move we got going on here. There was a good tweet I saw out there about the terminology overbought, oversold, and what we associate with that terminology. And this sometimes, when you get to an overbought condition, it's like a stamp of approval. It's like a stamp of strength in terms of a trend. When you are trending, these oscillators get into the reversal zone. When you are strongly bullish, when you're weakly bullish, they don't. So the fact that the intermediate line is still strongly up there confirms a strong bullish trend. The fact that the near-term line finished up there confirms a strong near-term run, and the momentum line up there means that we had a pretty decent range today and closed right at the high, which is exactly what happened. If you take a look, one of the things I looked at in our Q&A session this morning was this idea that we are up 7% off of this October 8th low point since this near-term run started, this is day 27 of the near-term line being above 50. So a really decent run here. But day 27, and you'll notice that we haven't had a 1% decline this whole time. Now, the last time we had a 7% run, in this case, or more, without a 1% pullback. See, that wasn't even a 1% pullback. Was right here in June, coming off of the June 3rd low point all the way up to June 20th, which also similar to here, happened to be the end of an expiration cycle. So we rallied into the expiration cycle. We got the 1% dip, which turns out that was a 23% retracement, kind of the expectation we expect to see here on the S&P as a drop down to 3060 in this area, which would actually be a 30%, a 23% retracement, and would be about 1.5% similar to that. I mean, it would be an exact same type of move as you saw here in post expiration in June, before we continued to rally up another 3.5%, 1% pullback, and then another 1% rise, and then we had our declines into August. I expect that we'll continue to rally like this to some degree. I don't know exact numbers, but into the end of the year after we get, at least a 1% decline here coming off of this peak. And you notice we gapped up. So, it's got a lot of potential being a short-term blow off top, not a, oh no, here we go into this type of pullback or this type of pullback here. No, I'm not looking for a 5% or 10% pullback on any time soon. But in the short term, with an overbought cluster and 27 days and the near term line being up above 50, that kind of tells you that it's run its core. Like this might be the last little gas breakout, especially the day of expiration, essentially, before now we pull back. And again, like I said before, and I've said for the last few weeks, so the expectations of a pullback is nothing new, right? We've gone into the last few weeks expecting a short-term pullback because the typical near-term run's 12 days. So, and it doesn't have to pull back next week either. We can continue higher. We could be 32 days above 50 on the near-term line by the time we get to next week, for all we know. That'd be a very long time, but it wouldn't be the longest ever, but it'd be up there. So, stocks, markets can stay overbought, especially if you try to short it. Markets can stay overbought for a long time. And fortunately, in our class portfolios, we've been bullish. Now we've been adding, and we'll add a bearish trade today. We've been adding some bearish trades here and there just to sprinkle some into our active trading portfolio because we've been so bullish in our class portfolios. But and I'll show you an example of that in today's trade with today's trade idea. But that doesn't mean I have to be aggressively bearish to try to catch that falling knife or try to catch the top. Because we just don't know. We don't know where that top is going to be. It wasn't over here. You see, you had a gap up here on 620. Again, very similar to what we see here. We did fill in the gap throughout the day, but we still had a strong gap and finished up where we opened. And then one more day to expiration, and then we had the 23% full pullback. So I expect a very similar pattern to come out of here where we pull back down towards 30.65 where that 23% retracement is. You can see the Dow came really close to an overbought cluster as well. The NASDAQ Composites near-term momentum line jumped way up, and you can see the gap there. And then finally, the Russell 2000's near-term line bounced up from being oversold. So again, that's not very typical of bullish markets. And you can see the near-term line did not gap up to an all-time high, did not gap up even to a 52-week high. So it's not nearly as strong, and we've had the pullback. So this is something we expect to see from the rest of the indicators. And because we've been so bullish in the short term for so long, don't expect a 1 to 2 day near-term pullback, and then here we go again. Expect a couple of days of pullbacks, a couple of days of bounce, a couple more days of pullbacks, and some choppiness before we get that next 7 to 12 day near-term run up above 50. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, hit the thumbs up icon that's down below the video. That tells us two things: that you liked our video and that you want us to do it again on Monday. So it's a quick way to give us feedback. It's our survey that we send out essentially. We take a look to see how many thumbs up we get compared to the views. So if you like the video and you want us to do it again, let us know with one click down below. And also while you're down there, comment on what you got out of the video today. We're always interested in that as well. Join our website at marketscholars.com. You can do that for free by clicking on that link up there. That will give you access to our Market Outlook forums. So our community, portion of our community that's dedicated to this video, you can be able to engage with other Market Outlook viewers, as well as our market commentary portion of our blog, webinars that we put out there every so often. So you get access to all of those with a free subscription to our site. Also, follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created for you. If you're watching our video on our site, we invite you to check out some of the other stuff that's here. This link here is to our Market Outlook Live trade review videos that we do, where we take our trade ideas in these videos and we manage them all the way to their close. We can teach you not just a trade idea, but also all the way, like the trade idea all the way. There's not a lot of people that will do that. They usually will tell you trade this, trade that, trade this, trade that. But we do. We give you an idea here, and then we continue with it all the way to the time we get out of it, from start to finish. And then we manage all of our trade ideas in that video right there. So there's a link that takes you there. There's upcoming classes as well. You get access to all of this with our Plus subscription plan. Down below you have our Market Outlook tweet and Facebook post. We invite you to engage with us with those, because the more you engage with us, the more you guarantee that Twitter and Facebook will promote our content to the top of your timelines. So you have to engage. We try to make it really easy for you. Just hit this little heart, opens up that window, hit that like button, hit this image, takes you to your Facebook page, and you can like it from there. All right, back to the charts, and let's take a look now at the long-term chart here. Look at that nice, good bullish close on the Heikin Ashi. Now remember, the Heikin Ashi's, the high was 30.97. We closed at 30.99, so we closed above last week's high, very bullish. In fact, we've done that now for 3 weeks in a row, where the Heikin Ashi close has been above the prior candle's high. That's rare. It's not common. It's not common to do that. I mean, you can get up to the high point, but it's rare for us to close above the high point, because that means, remember, the Heikin Ashi close is an average of 4 different prices: the actual open, low, high, and close. So when you look at the actual candle here and you average out all 4 prices here, that gives you the Heikin Ashi close. And so for all 4 prices to be up high enough to get the average up above last week's actual high point of 39.7 is really bullish. And like I said, it's rare for that to happen, so I wouldn't be surprised if we don't get that above 31.20 this week. It doesn't mean that we'll reverse, but you can see you can slow down and stay below the prior week's high point, like you saw here in July. In fact, if you go back to that June, where was it? It was the June, this little move right here. So June 20th and 21st. So that next week of the 24th is where we had that 1% pullback, similar to what we're expecting here this week. So to kind of give you an idea of what that looks like here, June the 24th, that week is right there. So that week right there, you notice we didn't close above the prior week's high point, and we had 2 weeks in a row, but we didn't that week, the week of June 24th, because we had a 1% pullback in there after a 7% rally during those 2 weeks. So now we have that 7% rally here, and again, I expect a similar type of candle where we don't get up to a higher, we don't even get up to a higher high on a weekly basis, much less a close above that high. So that's kind of what I'm expecting here going into next week. Let's take a look at the 3 green arrow charts for the S&P 500. We'll start off first with this SPX. And you notice we got the green arrow again after a brief 1 red arrow signal on the MACD, which is generally where the first red arrow comes from, is usually the MACD comes first. You know, we are well up above the 8-day moving average. In fact, we've been above the 8-day moving average now. You know, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26 days. It's a long run. It's hard to, even over here in that June time frame, we weren't that many days up above the 8-day before we pulled back below it during that 1% decline. So, and if we pull back down the 3.0 to 30.65 or whatever, we will get below the 8-day at that point. So again, that's a long, long run. If you notice here, give you some context, it's not too common to stay above the 8-day for that long. You can even see over here, a couple times we dropped below there. You can see all the times over here you drop below. So in fact, I can visually show that to you by coming over here to the exponential moving average and do the 1-8. And then let's just not show the, we won't show the average, we'll just show the MACD itself. So when this MACD is up above 0, you can see that when it's above 0, in fact, let's get rid of the histogram while we're at it too, so we can there we go, just focus on when it's above 0, that means we're above the 8-day. When you're below 0, you're below. So you can see the runs when you're above 0 over here. This is probably one of the longest runs in a recent history, because that got to 0.2, that got to 0.5. So that was a run of, see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17, 18, 19, 20, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, and then on the 42nd day we finally closed below 0. So 41 days. Now, a key distinction between this run off of this June 3rd low point versus the January 3rd low point, right? As to, you know, how likely we're to get another 40-day run. A key distinction here is on the January 3rd low, the VIX right there, the VIX was at 25.5. On the June 3rd low point, which is right, excuse me, not the June 3rd low point, it would be the October 3rd low point. So right here, we were just barely above 20. So the VIX was coming off a much, much higher high and coming down from that high than we are here. So hence the 40-day run there. And now that we're 26 days, and you can see here that, you know, during that 40-day run, we didn't get to extreme lows, whereas we have here. So that, again, kind of shows you the difference as to why that lasted so long and why this shouldn't be expected to last nearly as long. So now let's take a look at the intraday chart here for the 4-week range. And, you know, we are back up to about let's see, 12 points, a point and a half, so about 13.5. We're not quite to that 5% mark as we really kind of push the envelope again. So we push the high up and this low point by the end of next week. So get rid of 1, 2, 3, 4, 5 days. By the end of next week, we'll be at 301. Will be the low point next, depending upon how far we pull back, which I don't expect us to pull back to below 302 next week, if we pull back at all. And so that would move us to 301, and that would be a 10-point move, which is well below 5%. So you can see if we do kind of pull back into this range, this purple line, which is what I fully expect, because I think this is a little bit of a blow-off breakout. Those get filled in. Those gaps get filled in. So I do expect us to come in back into this range. Nothing more than that. 306.5, that would be down roughly to this area is where your 23% Fibonacci retracement is. So if that happens, then, you know, and it takes all week and we don't get a new high, then that will be easily below the 5% mark. And it would set us up for a bounce up to a new near-term run that continue to push significantly higher. You know, it's not significantly, not the same 7-8% move like we've had, but to continue the intermediate run into the end of the year as we expect it should happen. Let's take a look at today. Interestingly enough, another thing too that kind of stood out to me about today's move is when you take into account the gap, 309.55 is where we closed, the low at 310.26. So we had about a 4571.71 gap that you add to this. So that puts us up to 2.29, which is a little bit above the average ATR. Even though that ATR is really low, it's a little bit above average range, and we haven't had above average ranges for quite a while. And you can see the volume at 62 million is a little bit above average too, and we haven't had that for quite a while. So it's not very high numbers. These aren't high numbers, But when you consider the range we had before was 1.5 points, 1.88, 1.84, 1.27, 1.97, 1.99, 1.34, 1.21, 1.04, 1.45. So you can see we've had really, really small ranges, even including the gaps. So, so that really was significant in that this was a bigger range, including the gap. This was a pretty significant range compared to the recent past. And the volume, the same thing. The volume, what being above average, is some of the higher volume we've had since he's a couple down, a couple relatively bearish days here, and then that breakout. So on a day like that, again, when you're kind of looking for short-term overbought conditions and you see a gap up that's above average in volume and trading range, it increases the likelihood, not to 100%, because nothing ever is, but it increases the likelihood that that could be our short-term top right at expiration there before we get even just a 1% plus pullback, which would be very normal for the type of inhale-exhale pattern you expect out of stocks. I already showed you the volatility chart here. And you'll notice, again, closing below 12. So it's the lowest close we've had during this whole run. And the last time we've closed here on an overnight base, like that was the extended hours. So by the time we got to a regular close, this 1205 is the lowest regular close that we've had since April the 12th. I remember that June time frame, right there, the June 20th. We had peaked right there in June 3rd to June 20th. So that's the run that volatility made during that last 7% plus rally, and then this is the 1% pullback. Well, here's the run here. So we've pulled down a lot further from similar levels, and you also notice that on a relative basis, we went from above, right around 100%, all the way down to the 90% level, and then we bounced in the neutral area. Here we went from 100% all the way through the neutral area, all the way to extreme lows. So that's why, again, I expect any bounce we get to peter out at 15, and for this to peter out at 90, if we even get to that point. All right, so before we move on to fundamental factors and what's driving the price action, then our trade idea, what do you think about that technical assessment we just came up with? Do you agree with it? Do you disagree? Let me know by clicking that link right there. Opens up a poll. Then you vote, agree or disagree. If you disagree with what we came up with, let us know why. Like, what are you seeing? What indicator? What chart are you seeing that suggests something different than what we came up with? I don't mind differences of opinion. I just also want to know what's driving your opinion, because I just don't want your opinion, right? We want to share ideas with the community and see what I might be missing from this technical summary that I just came up with my normal routine here. All right, now let's take a look at what's driving the price action and transition into that. So let's take a look at the different asset classes, and here's where that near-term run started on 10/8. So if I were to go back to 10/8, here we go, all the way up till now, and we'll give ourselves, let's see what that looks like. Yeah, that's okay. So here's the intraday chart of that move. You can see we gapped down on 10/8, and then we've rallied through. Here's all the equity asset classes: SPY, IWM, EEM, and EFA all up here. Crude oil being the big winner during this whole risk appetite run. Emerging markets were doing really well. They've pulled back a little bit. In fact, a lot of risk asset classes have pulled back, except really for the S&P 500. High yield bonds are doing okay. They're outpacing treasuries significantly. Treasuries have really struggled, and so has gold. So you can see the risk appetite trade in real estate as well. You can see the risk appetite trade unwinding. They've been bouncing this week. So as bullish as we were this week, so now let's change this to November, and then we'll look at just how we performed here this week. And you can see it's a little bit of a bounce in risk gap and the safety trade because it's been so oversold. So treasuries bounce, gold bounce, real estate bounce. They stayed up. Gold flattened out a little bit as stocks rallied here at the end of the week, especially with this gap up we had today. So, it looks like, and you can see emerging markets were down most of the week, and developed markets as well. They've been so strong lately. So it looks like this was a risk-off week, but by the end of the week it wasn't because of that gap up. So that's another reason why I think we're probably going to erase that gap up because the rest of this pattern shows this was a risk-off week. It was a profit-taking week. It was a sell what's been working, buy what's been really underperforming, kind of an exhale type of week, because that's generally what happens in exhales. Not that we expect bonds to go up, not that I expect real estate and gold to rally again. I expect them to continue to trend lower, but a trend is lower high. A bearish trend is lower highs and lower lows. So lower lows as well as lower highs. So lower highs are developed when things bounce off of lower lows. So here is one of those bounces for these safe haven trades that are starting to trend bearish. If you take a look at the Heikin-Ashi candles for like long-term bonds, which have been so bullish, right? Well, they're pulling back, and they've still got bearish candles. We're still filling in this gap to the 200-day moving average. I expect that, and there's the bounce, like we've seen other bounces. I expect that we'll continue to fill in that gap towards this Fibonacci support, potentially even down towards 130 in that area. And if you take a look at gold prices, you can see similar, a little bit of a bounce here, still filling in the gap between the 50 and the 200 when you have such strong PPO down there. Here's the Heikin-Ashi candle, still showing bearish candles here, and no long upper shadows. So we're not anywhere near a transition yet on that one. If you take a look at crude oil, you can see it's still, similar to this kind of the risk trade, as bullish as stocks have been since October the 8th. You can see here, as well as to some degree at the Russell 2000, the risk trade has not taken off yet. You can also see it too in this chart that we like to look at, which is kind of like our FANG conglomerate, which is 5 of the 7 biggest companies that represent these cyclical areas, XLC, XLY, XLK. And you can see how it hasn't broken out yet either. This kind of blue line there, you want to see a good Heikin-Ashi close up above that blue line where the highest closes are for the year. So that kind of shows, and a little bit of what I talked about in the technical analysis class yesterday. So in technical analysis, on Friday morning, last week we talked about, is this a euphoric market? And what the last euphoric market we had, how does it compare now to then? In yesterday's class, we said, okay, we were really bullish in the short term. What about the long term? Are we closer to the beginning of a bullish long-term run? Are we closer to the end? So we broke that down in today's in this week's technical analysis class. Remember, you get access to that class and the other 7 trading rooms with your Plus subscription, the $99 a month. So if you want to check that out, you get access to the archives as well. Sign up for that subscription there. You can go check that class out and see what we talked about this week and last week. Excuse me. So you also see too, I wanted to bring up, let's see, is it this chart here? Yeah. So I wanted to bring up, you can look at the economic indicators. I mean, we've come off of lows. We kind of peaked in early 2018. That's when the stock market peaked. We had a little bounce here in August, October, but then we continued lower. Well, if you look at a lot of the technical indicators here, let me bring this over. So here's the indicators that were released on Friday's calendar, yesterday's calendar. Here's the import price index. You see how we peaked in July of 18. We had a really strong this is year-over-year import prices, and you can see we're continuing still lower. Export prices, same thing. We peaked there a couple months earlier. We continued down. You look at the Empire State Manufacturing. Here's August 2018. We haven't bounced yet. You look at, we'll come back to that in a minute, the industrial production. Here's August 18. You can see now we're negative on a year-over-year basis. And then retail sales was the last indicator that was released on Friday. Again, July, August, we peaked here on a year-over-year basis, and now we're down below 3%. So we're still pulling back. So on a macro level, we haven't bounced, even though the stock market itself has, and not just here in the U.S., but globally. So when you look at here, the economic surprise index, you can see, we're looking better, but we haven't really taken off yet. When these take off to really strong positive numbers, including globally, then we can run. We can have a run on risk appetite for quite a while. And that was, like I said, there was quite a few things coming out here next week. If you take a look now, next week, remember, is the last full week before the holiday, for the Thanksgiving holiday. We have some housing indicators out. You have housing market index, which is a sentiment survey of home builders. You have housing starts. You have existing home sales over here. So a lot of housing indicators, and then you have your FOMC minutes and your Philly Fed survey. The other, like the Empire Manufacturing, the other major regional survey. Again, a survey, so it's not hard data. It's actually soft data. Next week, you have a big retail earnings week. So you have Home Depot, Kohl's, TJX. Here on Tuesday, you have Target, Lowe's on Wednesday, and then you have Macy's, Nordstrom's here on Gap as well. But you have those are the big ones there, Macy's and Nordstrom on Thursday, and then some other smaller retailers also on Friday. So a big week. Medtronic as well from a healthcare standpoint, but a big week for major retailers out there. So as you saw, retail sales have been a little weak. You can see the GDP has been getting progressively, like the last third quarter has been pretty weak. The consumer is weakening. Well, if you look at the GDP estimates from the Atlanta Fed for Q4, this was updated on Friday as well, and look, it's barely above 0%. So we've really dropped from 1% down to 0, with the industrial production and the retail sales still showing still showing weaker year-over-year figures. So with all this bullishness from a macro standpoint, we are definitely not looking like we did in 2018, where we were extremely overbought on the markets and peaked in early 18 and then peaked again in October after all these macros peaked. So they haven't bottomed yet. Stock market's already kind of started to lead the way higher, so I expect them to bottom. But it kind of shows again how much potential risk appetite has going forward, especially on a global basis, because they've been a lot more bearish in a lot of these major economies, more so than in the U.S. You can see from a global standpoint here, let's look at the 12 grid. The 12 grid here, you can see how Korea has been doing really well. Here we go. So you can see how strongly bullish these are. When we were bullish in 2018, these were not strongly bullish. They were lagging behind. And we do have some light pink and dark pink shading, but with yellow lines, these are considered buying opportunities in Brazil and China, and for that matter also in India. And where's the other pullback? I guess it would be here in the UK. So we've had the dips here, and there's some buying opportunities to continue. Some really strong trends we have globally, not just in the US like we saw last year. Now let's take a look at the sectors, and if I come back here to the sector comparison chart and take a look here at this custom time frame from the low point of the 8th up until now. So industrials, financials, technology, you can see healthcare with a big jump up, which is good for us because we have some healthcare positions in our class portfolio. You can see lagging or real estate and utilities and staples. Well, again, let's take a look at just this week here. November from the 11th. And let's go back. Let's do like a 15-minute chart. And you can see, look at real estate, and there's healthcare, which is sometimes considered a safe haven sector. But there's real estate, utilities, and then staples you can see was doing really well until Friday, where it flattened out and other sectors caught up, like healthcare and technology kind of passed them. But staples still outperformed the broad market. So safety trade. So again, until Friday, it was a safety trade. In fact, if I were to change this to not include Friday, it was a safety trade week. You would have expected this to be a risk-off week going into Friday with that blow-off. So again, another reason why I don't really buy that blow-off move that we had on Friday, and I expect that we'll continue with some risk-off type patterns into next week. All right, so when we're so aggressively bullish in the short term like we are right now, I can start to add some bearish trades to my portfolio without being aggressive, right? I still like to have a strong bullish delta overall because of how strongly bullish the trend is. But when you're short term like this, it's not a bad thing to add a little bit of bearishness. So that's kind of the main idea behind today's trade idea. And one of the stocks, Whirlpool, that is showing a little bit of a breakdown that we had today, breaking below 150, is you can see Whirlpool. So we have dark pink shading, pink lines, so bearish, strongly bearish trend here going on. You look at the 3 green arrow chart for Whirlpool, and you can see big volume on today's breakdown, big volume with 3 red arrows and a bearish trend. You look at the crossover here, the long-term chart, and you can see that we are filling in the gap between the 50 and the 200-day moving averages here. It doesn't mean we have to keep going down, but it's going to be really easy to stay down with Hakinyashi candles filling in that range. And then you notice, like when you look at like the Bollinger Bands for Whirlpool, again, you can see probably 140 is where you'll get some support after having broken below into the value area and below this little node right there, which now will act as a resistance at 150 to the upside. When you look at the directional movement index for Whirlpool, you'll see that the negative directional index got strongly up above 36. So again, it doesn't mean that we have to keep going down, but it's really easy to stay down when you're that bearish in the directional index, combined with that bearish on the positive line being that low as well, well below 20. So well above 25, well below 20 there. So strong bearish pattern. In fact, if you look at the Ichimoku cloud for Whirlpool, you can see that we are flirting with the bottom end of the cloud. Bearish pattern on the lines, a bearish crossover. You can also see too that the red line as well, which is today's close, is well below the close from 26 days ago. And we're starting to get a moderate strength bearish trend with this dropping below -2. And in fact, if you also take a look at the RSI and CCI for Whirlpool, we drop below 40 and we drop below -200. So again, nothing's perfect, nothing's ever 100%, but those are signs that we could be bearish for a while. At least that it's not going to be easy to turn around and be bullish again. I wouldn't, if it does, like here, I wouldn't expect us to get above 60 on the next move higher. I'd probably expect us to peak right around 50, maybe a little bit above 50. Same thing on the CCI now that we've dropped below -200 there. Again, similar to over here where it didn't continue a really strong bearish trend, but it was really easy to stay down for a while. And I expect this to stay down below into December expiration. I don't have to worry about earnings there with December expiration. So here's the trade. Again, I didn't do a market outlook live on Friday, so we didn't put this in before the close. But here's the trade. So selling the 150, which is why I told you that new resistance is, that volume node, and then buying the 155 for protection, getting at least $1.16, so we're getting enough credit. Position sizing around a full position because we don't have to worry about earnings and the trend in the short term, I expect to be in favor of this trade from a broad market standpoint. So trying to go for 378. If I can get half of that quickly, great. Otherwise, I go for 378, which means I'm willing to lose 378. So if we break back above 150 and we get to the point where I'm down 378, then I'll take that loss without not letting it get all the way to 1122, and then I'll move on to another trade. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link right there to go to our Market Outlook forums on marketscholars.com. And let's keep this conversation going. What questions or comments do you have for me about anything I talked about in today's video, or for that matter, anything I didn't talk about? I had a Q&A session today for clients, for our premium clients over WebEx, but here's our chance to do some Q&A in the forum. So let me know. Remember, you can also answer each other's questions with what you know as well. It's meant to be a community, not just a one way or one person interaction. Follow me on Twitter for more content like this in between these videos that we do from day to day. Join our Facebook group that we created for you as well to continue to strengthen that community of Market Outlook viewers, as well as our website, as I showed you earlier with that link for free at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.